April 24, 2023, after the closing bell, First Republic Bank disclosed that customers had withdrawn more than $100 billion in deposits during the first quarter. The number was staggering. In less than 3 months, roughly half of the bank's deposit base had disappeared. Markets reacted immediately. Shares fell sharply in after-hours trading. Confidence, already fragile after the collapse of Silicon Valley Bank, weakened further. Within a week, First Republic would be seized by regulators. To understand how a long-respected private bank unraveled under deposit pressure, you have to begin years earlier. During a period of low interest rates and rapid asset growth, First Republic Bank built its identity around high-net-worth clients. Headquartered in San Francisco, the bank focused on wealthy individuals, private business owners, and professionals. According to regulatory filings, its strategy centered on relationship banking. It offered customized mortgages, wealth management, and personal banking services to affluent customers. This model created loyalty. It also created concentration. During the 2010s, and especially after 2020, low interest rates fueled demand for large residential mortgages. First Republic became known for offering jumbo mortgages to high-income borrowers at relatively attractive rates. According to SEC filings, the bank expanded its loan portfolio significantly during the low-rate environment. Deposits grew alongside lending. By the end of 2021, First Republic reported total assets exceeding $180 billion. Deposits were heavily skewed toward large accounts. According to regulatory disclosures released later, a substantial portion of deposits were uninsured, meaning they exceeded the $250,000 FDIC limit. At the time, that did not appear problematic. Wealthy clients valued personalized service and convenience. The bank's credit quality was widely viewed as strong. Its borrowers were typically high-income professionals with significant assets, while structural risk was building beneath the surface. Like many banks during the low-rate period, First Republic funded long-term assets with deposits that could move quickly. Its loan portfolio included long-duration, fixed-rate mortgages issued when interest rates were historically low. According to financial disclosures, the bank also held securities that declined in value as rates rose. In 2022, the Federal Reserve began raising interest rates at the fastest pace in decades. Treasury yields climbed. Mortgage rates rose sharply. The market value of existing low-rate loans and bonds declined. First Republic did not face a credit crisis. Its borrowers continued making payments, but the economic value of its assets declined in a higher-rate environment. Meanwhile, deposits remained concentrated. In March 2023, Silicon Valley Bank failed after experiencing a rapid deposit run. Confidence across regional banks weakened. Investors and depositors began scrutinizing institutions with high levels of uninsured deposits and large unrealized losses on securities. First Republic fell into that category. Between March 9th and March 31st, 2023, customers withdrew more than $100 billion from the bank. According to its earnings release filed with the SEC, that represented an extraordinary shift in liquidity within weeks. The speed reflected modern banking behavior. Transfers could be initiated online. Wealthy clients could move large balances instantly. Financial advisors and private banking networks communicated rapidly to stabilize the situation. A group of 11 large U.S. banks announced on March 16 that they would deposit $30 billion collectively into First Republic. According to public statements from participating banks and the Treasury Department, the move was intended to signal confidence and support financial stability. It bought time. It did not restore durable trust. The bank began borrowing heavily from the Federal Reserve and the Federal Home Loan Bank system to meet liquidity needs. According to regulatory disclosures, borrowings rose sharply as deposits declined. The structure that had driven First Republic's growth now amplified stress. Its business model depended on stable, affluent clients. Its assets were long duration and low yielding relative to rising market rates. Its funding base was concentrated and largely uninsured. The incentives that shaped prior decisions were understandable. In a low-rate environment, extending fixed-rate mortgages at attractive terms helped grow market share. Retaining wealthy clients strengthened brand identity. Expanding assets increased revenue. But as rates rose and peer institutions collapsed, behavioral dynamics shifted. Risk that once seemed remote became immediate. By late April 2023, First Republic faced mounting pressure. Market capitalization had fallen dramatically. Analysts questioned its ability to operate independently without significant restructuring. The next phase examines the mechanics of the balance sheet, the regulatory framework, and the liquidity dynamics that turned deposit outflows into a terminal crisis. By mid-March 2023, First Republic Bank was operating in a narrow corridor between survival and resolution. The bank's problem was not rising loan defaults. According to regulatory filings and quarterly reports, credit performance remained relatively stable. Borrowers were largely high-income individuals with strong repayment histories. The stress was structural. First Republic's asset base was heavily weighted toward long-duration, fixed-rate residential mortgages. Many of those loans were issued when rates were near historic lows in 2020 and 2021. As the Federal Reserve increased policy rates throughout 2022 and into 2023, market yields on comparable new mortgages rose sharply. When rates rise, the value of existing fixed-rate loans declines. This is not a default issue. It is an interest rate sensitivity issue, according to financial disclosures. First Republic also held investment securities that experienced unrealized losses as bond prices declined. Similar to other regional banks, a portion of those securities were classified as held to maturity. That accounting treatment meant unrealized losses did not immediately flow through earnings, provided the bank could hold the securities until maturity. But accounting stability does not eliminate economic exposure. The core vulnerability was funding. A large share of First Republic's deposits exceeded the $250,000 FDIC insurance threshold, according to public disclosures made after the crisis. The percentage of uninsured deposits was significant relative to total deposits. In calm conditions, affluent depositors may value service and relationships. In stress conditions, uninsured status changes incentives. The collapse of Silicon Valley Bank in early March 2023 altered depositor psychology nationwide. Even though First Republic's asset composition differed from SVB's venture capital exposure, both institutions shared a key feature: a high concentration of uninsured deposits. Once withdrawals accelerated, the bank had to raise liquidity quickly, according to regulatory filings and company disclosures. First Republic turned to the Federal Reserve's discount window and other borrowing facilities. Borrowings from the Federal Home Loan Bank system increased substantially. These facilities allow banks to post collateral and obtain short-term funding. However, borrowing to replace lost deposits changes the economics of the balance sheet. Deposits, especially non-interest-bearing accounts, are typically a low-cost source of funding. Emergency borrowings are more expensive. As borrowings increase, net interest margins compress, profitability declines. By the end of the first quarter of 2023, according to its earnings release, First Republic reported that total deposits had fallen by more than $100 billion compared to the prior quarter. Although the $30 billion deposit infusion from large banks provided temporary support, it did not reverse the broader trend. The bank's management announced plans to restructure the balance sheet, according to public statements. They explored options including asset sales and strategic alternatives, but asset sales in a rising rate environment create challenges. If long-duration loans or securities are sold into a higher rate market, losses may need to be recognized. Recognizing those losses reduces capital. Reduced capital can further weaken confidence. This dynamic creates what analysts sometimes describe as a liquidity trap for banks with duration exposure. Holding assets preserves accounting capital, but depends on stable funding. Selling assets generates liquidity, but can erode capital. At the same time, investor confidence was deteriorating. First Republic's stock price fell sharply throughout March and April 2023. Equity markets were signaling doubt about the bank's standalone viability. Ratings agencies downgraded the institution's credit profile. Market volatility made raising new equity capital difficult. In earnings disclosures, management acknowledged that strategic options were under consideration. According to regulatory filings, advisors were engaged to explore potential transactions. Behind these developments were structural lessons. First, interest rate risk had been underestimated across parts of the regional banking sector. During the prolonged low-rate period, extending fixed-rate assets generated steady income. Rapid rate increases exposed duration sensitivity. Second, deposit concentration created vulnerability. A client base composed largely of high-balance accounts can withdraw funds quickly, particularly in an environment of heightened awareness. Third, Communication speed amplified stress. Financial news circulated instantly. Social media commentary influenced depositor behavior. Transfers could be executed in minutes. Regulators monitored developments closely. The Federal Reserve, the FDIC, and other agencies evaluated contingency options. According to later statements, supervisors were assessing liquidity and capital adequacy as conditions evolved. By late April 2023, First Republic was operating under intense pressure. Borrowings had replaced much of the lost deposit base. Profitability was impaired. Market confidence had eroded. The remaining question was not whether the bank faced strain. It was whether an orderly solution could be achieved without broader disruption. Part 3 examines the final weekend, the regulatory seizure, the acquisition by a larger institution, and what the collapse revealed about mid-sized banks in a higher rate environment. April 28, 2023. Markets closed with First Republic Bank trading at a fraction of its value from earlier in the year. Investor confidence had deteriorated further after the bank reported its first quarter results. The more than $100 billion deposit outflow was now public. Analysts questioned whether the institution could survive independently. Behind the scenes, regulators were preparing for resolution over the final weekend of April. Federal authorities coordinated a bidding process, according to subsequent regulatory disclosures. The Federal Deposit Insurance Corporation sought to arrange a purchase and assumption transaction before markets opened on Monday. On May 1, 2023, the FDIC announced that First Republic Bank had been seized and that most of its assets would be sold to JPMorgan Chase. According to the FDIC's official statement, JPMorgan agreed to assume substantially all deposits and purchase the majority of the bank's assets. The agency estimated that the resolution would cost the Deposit Insurance Fund approximately $13 billion. The figure was publicly disclosed in regulatory releases following the transaction. This marked one of the largest bank failures in U.S. history, following the collapses of Silicon Valley Bank and Signature Bank earlier that spring. Unlike a chaotic liquidation, the resolution was structured to minimize disruption to depositors. Customers retained access to their funds. Branches reopened under new ownership. The objective was continuity, but the collapse was the culmination of weeks of structural strain. The $100 billion deposit flight had effectively destabilized the bank's funding model. Even with the $30 billion support from large banks in mid-March, confidence did not return. Borrowings from emergency facilities remained elevated. Market access deteriorated. In reviewing the episode, regulators focused on risk management and supervisory oversight, according to public statements and regulatory reviews conducted after the crisis. Supervisors had been monitoring interest rate risk across regional banks throughout 2022. Rising rates affected many institutions, but those with concentrated uninsured deposits and long-duration assets were particularly vulnerable. First Republic's core business model had strengths. It cultivated affluent clients. It maintained strong credit performance. It emphasized personalized service. But the same model carried structural exposure. A high proportion of uninsured deposits meant that large clients could move funds quickly. A portfolio of low-yielding, fixed-rate mortgages reduced flexibility in a rising rate environment. Heavy reliance on wholesale borrowing once deposits left increased funding costs and compressed margins. These factors did not represent misconduct. They reflected strategic positioning shaped by years of low interest rates and competitive pressures. In a low-rate world, offering attractive long-term mortgages built market share. Retaining wealthy clients strengthened brand identity. Growing assets increased revenue. The incentives were aligned with growth. When rates rose rapidly, those incentives produced unintended consequences. Asset values declined. Funding became less stable. Behavioral responses accelerated stress. Regulatory frameworks also came under scrutiny. First Republic, as asset size placed it below the threshold for the most stringent stress testing applied to the largest banks. After the spring 2023 failures, policymakers debated whether enhanced liquidity and interest rate stress scenarios should apply more broadly to mid-sized institutions. The broader system absorbed the shock. Large banks remained capitalized. The Federal Reserve's liquidity facilities stabilized funding markets. Depositors did not experience widespread losses. But the episode revealed a structural shift in bank. Treasurers can transfer funds instantly. Confidence can change within hours, not weeks. The destruction of First Republic was not triggered by credit collapse or fraudulent assets. It was driven by a funding model vulnerable to rapid behavioral change in a higher rate environment. The $100 billion deposit flight was both a symptom and a catalyst. It reflected depositor incentives under uncertainty. It forced reliance on expensive borrowing. It signaled market distrust. And it ultimately led regulators to conclude that resolution was necessary. In calm markets, relationship banking can be an advantage. In stress markets, liquidity becomes paramount. First Republic's fall underscores a modern reality. Asset quality alone does not determine survival. Funding stability, interest rate management, and depositor behavior matter just as much as interest rate cycles evolve. Banks must balance growth incentives with structural resilience. If you value measured, fact-based analysis of financial system events and regulatory decisions, subscribe for future investigations and in-depth financial breakdowns.